Is the end of the US dollar dominance coming? Ray Dalio, one of the world's most respected investors, has been warning about the risks, growing US debt, political polarization, and the rise of competing powers like China. He says these are the same forces that led to the decline of past empires and their currencies. So the question isn't if the dollar is strong today, it's whether it will remain strong tomorrow. In this video, we're going to break down Dalio's warnings, look at the numbers behind America's debt problem, and ask the uncomfortable question, are we witnessing the beginning of the end for the US dollar? Also, at the end, there will be powerful tips to help protect your wallet. I don't want to be sensationalist here, so we'll only talk about very reliable and meaningful data from solid institutions. In this channel, I don't want to raise false alarms or pollute you with market perceptions that aren't always accurate. If you like this approach, I invite you to subscribe. Thank you. Let's dive in. Well, first of all, Ray Dalio has been warning that the US is walking straight into a storm. And this isn't some clickbait headline, it's coming from the guy who built the biggest hedge fund on the planet. By the way, I have a video talking with Ray Dalio about crises on this channel. You can check it out in the card above. It's very valuable content. Well, let's start with the first red flag according to Dalio. Tariffs. Trump's new trade measures aren't just about charging more on imported goods. Dalio says they're a sign that the global order itself is breaking down, because tariffs don't just raise prices, they shift alliances. They push countries away from the US and they accelerate the rise of alternative systems. In his words, we are on the brink of the monetary order, the domestic political order, and the international world order breaking down due to unsustainable bad fundamentals. Think about that for a second. The US built its dominance on being at the center of global trade. The dollar became the reserve currency because every nation needed it to buy, sell, and settle debts. But when you start splitting supply chains and turning trade into a weapon, other nations begin to ask, why do we need to depend on the dollar at all? That's the first crack. Now, the second warning is even scarier. US debt. America today owes around 37 trillion. And the problem isn't just the debt itself, it's the cost of carrying it. Interest payments are exploding. Dalio compares it to an economic heart attack that could strike within the next 3 years if nothing changes. Here's the math. To stabilize, the US needs to shrink its deficit to about 3% of GDP. That means adjusting revenues and spending by around 4% of GDP, basically hundreds of billions of dollars. If they don't, the debt spiral feeds itself. More borrowing leads to higher interest, which leads to even more borrowing. It's like maxing out your credit card, then using another credit card to pay the first one. At some point, the system breaks. And remember, this is happening while the world is already moving away from depending on America. Dalio connects the dots. Tariffs split the world into camps, debt weakens the US internally, and the combination erodes trust in the dollar. This is why he keeps repeating that the US is facing risks very similar to those that brought down past empires. Not because tomorrow the dollar disappears, but because the fundamentals are going in the same direction. So let's put Dalio's warning into context, because this isn't the first time a dominant currency has faced decline. History shows a clear pattern. Every empire's money loses power when the empire itself starts to crack. Take the Dutch guilder. In the 1600s, the Netherlands controlled global trade. Their currency was the reserve of the world. But as wars drained their finances and new powers rose, the guilder lost its dominance. Now, the same forces are being discussed around the dollar. Heavy debt, political division, rising competitors. The question isn't if the US still has strength today. It does. The question is whether history is about to repeat itself. Okay, but now, moving on to a second topic of the video, let's look at the current situation of the dollar. How long would it take, more or less, for this fall to happen? And how can you protect yourself from all of this? Well, the dollar isn't going to collapse tomorrow. Right now, it still dominates about 90% of global foreign exchange transactions, and it makes up close to 60% of central bank reserves worldwide. That's still a huge lead over the euro, the yen, or the Chinese yuan. But dominance doesn't mean invincibility, and history proves that even the strongest currencies fall when the empire behind them weakens. Take the British pound. In the 19th century, the pound sterling was the reserve currency of the world. London was the center of finance, and Britain's empire stretched across continents. But by the early 20th century, cracks were already showing. The cost of World War I was so massive that Britain suspended the gold standard in 1914, brought it back later, and then abandoned it again in 1931. The empire was losing ground, its debt was piling up, and trust in the pound was fading. Then came World War II, which buried Britain in even more debt. By 1944, the US dollar officially replaced the pound at the Bretton Woods Conference as the backbone of the global system. And from there, the pound entered a long decline. Multiple devaluations in the 20th century, shrinking relevance in reserves, and today it represents less than 5% of global foreign reserves. That's the point. Reserve currencies don't die in a single day. They erode over decades. The pound didn't disappear, it just stopped being the center of the world. And that's exactly the risk Dalio is warning about with the dollar. So how long could it take for the dollar to face a similar fate? If history is any guide, we're looking at 10 to 20 years for a real structural shift. But even though there are indicators, there is no 100% certainty that this will happen. The question that really matters is, how do you protect yourself from this and from crisis in general? Because if you're watching me, you probably have a large portion or all of your money in the US market. So this content is highly relevant to you. As a Brazilian, I was born and raised in an emerging market, so I know what it's like to have higher inflation and a slower market. I built my company and invested until I reached millions in a more unstable and unpredictable market, mainly due to structural risks. I think I have a wealth of experience talking about asset protection during crisis, and I've always said that a strong portfolio rests on 4 pillars: international assets, real estate, stocks, and cash. Each one plays a different role in protecting and growing your wealth. And the key isn't to go all in on one, it's to balance them. That's why I use a rule of exposure. Never put more than 40% of your portfolio in a single asset class, and never go below 15%. This way, you're always diversified, but you still have enough weight in each area to actually make a difference. Stocks give you growth. International assets protect you from being tied to just one country. Real estate gives you stability and inflation protection. And cash keeps you liquid, ready to seize opportunities when volatility hits. Stick to this framework, and you'll avoid the classic mistake of being overexposed to a single bet, whether it's the dollar, the stock market, or real estate. It's not about predicting the future perfectly. It's about building a portfolio that can survive any future, because sticking all your money in one country, even if it's the US, is like betting your entire future on a single horse. Other markets have different economic cycles, growth drivers, and in many cases, healthier balance sheets. And it's not just me saying this. JP Morgan Asset Management's long-term capital market assumptions show that developed international stocks may outperform US equities over the next 10 to 15 years, with expected annual returns of 8.1% for EAFE, Europe, Australasia, Far East, versus 6.7% for US stocks. On top of that, Ray Dalio has put $1 billion into an emerging market ETF, signaling he also believes international exposure is essential. That's powerful validation from someone who builds strategies at the very top. Of course, it won't always be like this. Don't invest thinking you'll get good returns under all circumstances, but that's why we diversify. When one sector fails, the other will be winning. You'll always be right on one side. In the long run, that's very powerful. So how do you actually get international exposure? The easiest way is through ETFs and global funds that track broad indexes like the MSCI EF or the MSCI Emerging Markets Index. With one investment, you get access to hundreds of companies outside the US, but you can also go deeper, choosing regions or themes. Take the MSCI AF Index. Index, which represents developed markets outside the US, Europe, Australasia, and the Far East. The main ETF that tracks it, the iShares EFA, is up more than 20% just in 1 year. Over the past 5 years, it's delivered around 11% per year. In other words, international developed stocks aren't laggards. Now look at emerging markets. The iShares EEM ETF, which tracks the MSCI Emerging Markets Index, is up around 18% year to date. And here's the kicker. In 2025, emerging markets as a group have doubled the performance of the S&P 500. They're being powered by a weaker dollar, by capital inflows from Europe, and by much cheaper valuations compared to US companies. Analysts are even projecting earnings growth of 17% across EM stocks this year. JP Morgan's own analysis suggests that 25 to 30% of a portfolio should be in non-US developed markets, with an additional slice in emerging economies for those willing to take on more risk. And again, that's not about abandoning US stocks, it's about balancing your risks. Because if the US economy falls, your wealth shouldn't fall with it. I only mentioned ETFs here because I think truly investing internationally by transferring money to other countries also involves exposing yourself to the risks of other currencies. Therefore, it's much riskier, and the analysis of each carefully selected asset would require much more careful consideration. I wouldn't advise you to do this if you're an amateur investor. I'm not going to tell you to take all your money out of the dollar. Investing in other markets is enough to eliminate your significant exposure to the US market. After all, as I said, the dollar isn't going to disappear. But if you really want to take some of your money out of the dollar, there are a few ways to do it. The famous one is investing it in stores of value like silver and gold. Also, to close the video, I know you like Bitcoin, and you're right. I also have it in my portfolio, and it's a store of value that has consistently performed well over the last decade. There's a graph that shows that holding USD instead of Bitcoin in 2025 would have cost you 38%. That's powerful, honestly. I think it's a very volatile asset. So currently, it only makes up 7% of my portfolio. But depending on your risk appetite, it could represent anywhere from 1% to 10%. I think anything more is very risky. Not because I don't believe in Bitcoin's fundamentals, but because there are risks like quantum computing and the system itself. I can address this in more detail in another video. That's it, cousins. Stay invested.